Hello everybody, and welcome to this new IFTA webinar about analyzing and trading markets using the Wyckoff method. My name is Dan Valku. I'm a IFTA marketing director, and I'm seconded by Akram El Sherbini from ISTA Egypt as a webinar moderator. We have the pleasure to introduce Roman Bogomazov and Bruce Fraser. Both are recognized experts who teach and practice the Wyckoff method at the Golden Gate University in San Francisco and other institutions. We'll have 45 minutes, followed by 15 minutes Q&A. Please be kind and type your questions in the question box. Each question will be addressed at the end of the presentation. Akram will do this. As always, the presentation will be recorded and will be delivered to each society in about a week. Thank you one more time, Bruce and Roman, for accepting our invitation and sharing from your extensive knowledge. Now, let me switch the screen to Roman. Enjoy the lecture. 1 second, Roman, please. Okay.
Okay, can you see my screen?
Not yet, but yes, now. Yes, now.
Okay, great. And let me just check. Do you see the pen?
We see the pen.
Okay, great. Okay. Well, thank you for welcoming us to IFTA webinar series. It's exciting because, Dan, you started this program, a year ago, and now it seems like each month IFTA colleagues have this opportunity to listen to anybody in the world with the technical analysis knowledge, and I think IFTA is doing a great job, and I'm kind of looking to other presentations that you're going to line up for this year. Just would like to welcome my friend and my colleague Bruce Fraser. Bruce, hi.
Hi, Roman. Hi, everybody.
And I think that we're just going to let people read the disclaimer. This presentation is only for educational purposes. And because we don't have a lot of time, Bruce, I think that we should just jump right into the material and start.
Let's go.
Okay, so here's our first slide. And this slide is kind of like a description of who Wyckoff was, what he did, and some of the interesting people that he worked with together, talked to. And Bruce, again, because we are pressed a little bit on time, we're probably not going to go a lot into the history of the method or, Wyckoff's life itself. But I want to ask you a question because you're such a great storyteller. Why is it so important for us, to know the method from the perspective of what Wyckoff did with somebody like Jesse Livermore, James Keen? Why are we talking about him codifying those principles and why those principles still work today? This is probably one of the questions that I receive a lot. Do the principles that he described almost 100 years ago still work in the current market, and why?
Well, Richard D. Wyckoff was a self-taught individual who came out of a modest background and was just attracted right away as a youth in his teens to Wall Street and to the financial markets. And after a period of time working on the street, he started to realize that there was a way that speculation was being done by the people that were really, really good at it, and it was different from the way that the public and many other investors were doing it and consistently losing money. And so he decided that he wanted to understand what the real rules of the game were. And so he went on a quest to understand how the Jesse Livermores and the James Keens and others of that era had become so successful, and how so many others in large numbers had done poorly. And so what we're going to introduce today is a methodology that is based on what he discovered, and the principles of successful speculation in financial markets are today really very much the same as they were back in that era. Now there's rules today that are maybe more stringent, that it's you have to be more careful about following the rules. It was sort of the wild west back in the at the turn of the 20th century when Wyckoff was educating himself. And but the things that we're going to talk about today are just the principles of successful speculation. It's the way that very large market operators do it, and it's the way that we should be thinking about markets also. And so I think that's enough for now, but there's a very colorful history that Richard D. Wyckoff, the book on the left there, Wall Street Ventures and Adventures, is his autobiography, and he was a wonderful writer. So read all that you can that Mr. Wyckoff wrote, because he really is a very, very good, very clear writer.
Okay, great. Let's go to the next one. So here is a theoretical idealized price cycle, and usually this is where we start our studies at Golden Gate University with Wyckoff students. We want them to understand what is it exactly that we're looking for in terms of what we are looking for in a trade. Obviously, we're looking for the trades that are going to be trending, and we want to initiate those trades around the areas of accumulation and distribution. Bruce, why is it important for us, to look into the trading ranges? And Wyckoff studies has a lot to do with the trading ranges. And how can we possibly recognize any type of the directional bias within the trading range that could develop after the trading range?
Well, there's a principle at work here. This chart is incredibly important and deceptively simple. But what's going on in accumulation is the sideways market activity where prices trade in a wide bounding trading range where they seemingly go nowhere, but there's what we call intelligent activity that's occurring during accumulation. And intelligent activity is very large interests, which we call the composite operator, that are very good at what they do, that are accumulating large quantities of shares throughout the entire accumulation range. And we call this activity absorption. And this absorption is the careful accumulation of stock throughout. And what happens is that you can see the footprints of what we call the composite operator in this process of accumulation. And we actually break it down into phases, which we'll talk about. And so absorption in a trading range is an incredibly important concept. And once a stock has been absorbed, and so accumulation begins at the end of a large markdown. Some people would call it a bear market. So there's this large markdown, and the composite operator does not participate in the markdown phase unless they're shorting stock. They wait for the stock to reach a level where they're willing to start to reach in and start to buy it, and they will buy shares very carefully throughout, and they need to buy so many shares of stock. They need to absorb so much of the float of the stock that in aggregate among all of the different participants that call themselves composite, or that we call composite operators, that it takes time. It can take months and months and months to do this. And so they're very patient, they're very thorough, they're very good traders, they're very careful about the prices that they accumulate shares at. And so the same thing occurs with distribution. We're going to do future webinars where we're going to spend more time on distribution. But the concept here is simply that in distribution, the composite operator has completed their campaign. That campaign is from the buy zone to the sell zone. And so the composite operator is accumulating shares to hold those shares from the buy zone to the sell zone, which can take years to unfold. And then once you get into the distribution area, they just as carefully, just as thoroughly, and just as patiently distribute the stock that they own in the distribution area, which creates these large tops. Now, there's a difference in the way the principles of price activity unfold in distribution than the way it unfolds in accumulation. Because accumulation, even though they may look similar, accumulation is the absorption of shares of stock, literally removing them from trading activity, because the CO, once they accumulate those shares, they're not going to sell them until prices are much, much higher. Then when you get into the distribution area, they will distribute their shares very carefully, and they will distribute those shares until they're completely out, which means that the stock is gone from strong hands to what we call weak hands. And so the volatility that occurs in a distribution area is distinctly different than the way the volatility occurs in the accumulation area, which we'll get into a little bit of that today.
Okay. So I guess, let's say if I were a beginner Wyckoff, and I would ask you this question, so this is very interesting. To know that there is an accumulation going on in this consolidation, and you mentioned something about phases, something that the trading range can contain, and something that we probably can explore. So would phases or phase analysis help us out to determine when the price is ready to leave the trading range and to establish a trend?
Phases are great because phases, if we can understand the footprint of prices and the activities of the large informed interests, and we can see what they're doing, it allows us to pay attention, to be patient, and wait for the opportunity for us to jump on board and ride along with a composite operator. The composite operator needs the entire accumulation to be able to accumulate shares, where we, understanding the motives of the composite operator, are able to buy shares when the market is ready to move, and ready to move now for the stock or the instrument that we're trading. We do not have to sit through the entire accumulation area with our capital deployed waiting for the liftoff. We can wait and then participate once the liftoff is occurring. And so this is one of the really brilliant things about phase analysis, is it allows us to identify when to act, when to get busy, when to be patient and just observe, and then the different places that we can get on board as the markup phase begins.
Okay.
And we campaign our positions right along with the CO.
Okay, so you've been talking about this area right here, and we see here how the price is first testing the previous lows of the previous phases. Then there's something's going on with this rally, which is definitely much more substantial rally than any of the rallies that we've seen before. Then we're looking at this last reaction that reacts back into the trading range, into the area of the support which previously acted as a resistance. And that kind of, to me, shows a different action that we've seen in any of the other phases. So, and you mentioned that this is the first phase of the markup. So what, if this is the first phase of the markup for the trend, and this is where we should, start taking our positions. I wonder what's happening, you know, prior to that. How can we decipher, let's say, a stopping action of the major trend first? How can we look into the middle of the range and recognize that supply has been observed? What can we do there, Bruce?
Well, we're going to look for these characteristics of these principles in price bars and volume. And so when we combine our ability to observe the characteristics of price on classic, simple, straightforward bar charts with volume, we're able to see the activity of large interests versus the activity of everyone else. Because the one thing that large interests, the composite operator, this collection of all these different very wise traders, investors are doing, is that when they enter the market, we can see them because the volume expands dramatically. And so the one thing about the accumulation area is that the classic CO, this heuristic we call it, which is we call it a useful fiction because it's really a collection of a number of different competing interests that are all trying to buy the same stock, is that they will attempt to buy shares in the accumulation area and at the same time not trade or buy the stock badly, which would cause them to run the price up and out of the trading range until they've completed their entire purchase. And this is why they will be very careful. They will tend to buy in the bottom half of the trading range, and they will tend to suspend their buying activities when the stock gets up into the top half of the trading range. And so they will be attempting to accumulate on weakness. They will suspend their buying activities at the top of the range and wait for another trip back down towards the bottom. And this will go on until the shares just become more and more difficult to buy.
Mm-hmm. Okay. You mentioned that the principles behind accumulation and distribution are going to be somewhat different. Let me talk a little bit about the phases, the intention about the phases. So if we're looking at our first phase A, and this is the beauty of Wyckoff method in terms of defining the context of your signal. So there could be quite a few signals in the trading range, and usually for trend following traders, those signals are going to be whipsaws. So by putting the trading range into the context of phases, we can take specific signals and not all of them. So talking about the phases, the first phase A's intention is about a stop in action. What are we stopping here? We are stopping the downtrend from going further down. And Bruce has mentioned, you know, a climactic action, which is a first great place for big institutions to accumulate a sizable position because there's going to be a lot of fear, there's going to be a lot of supply, change of character on the first rally, automatic rally, and then the test, local test of the climactic action that we have. And that should stop the trend from going further down. It doesn't mean that we might not have lower lows after that. We might, but primarily we're going to be consolidating in this area. Phase B is all about supply and demand, how supply is being observed, how demand is being present. And therefore, with all of the swings that we have in phase B, we're going to be building a cause. One of the laws of the Wyckoff method is a law of cause and effect. And it states that we need to have a causality, enough time for big institutions to accumulate their position in order for us to have a long, sustainable trend. Institutions, when they buy a huge position, they're not going to sell in a month, in a 2, in 6 months. They're going to be holding this position for a long-term cycle, something like a business cycle from 2 to 4, 5, 6 years, depending on the specific industry group, depending on the specific economic conditions that we're currently in. Phase C, as I've mentioned, is the last test of the previous low. So it's the last test of the supply. Is there still supply left? And if there is some, institutions would love to get in at this low price before the trend and scoop everything that is left of the supply. Again, they want to control the supply to a certain degree because that's what would move the price up. And then on the way up, other institutions, maybe not so big, maybe some hedge funds, maybe some mutual funds, are going to come in. Their valuation timing models are going to define this area as a potential point of entry. This is where we want to operate as well. This area right here in phase D is going to show us a lot of change of character from what we've seen before. It's going to establish the stride of the trend, and from there the price is going to ease, is going to move with more ease. It's going to have more velocity to the upside. Spread is going to increase. We're going to have more dominant demand signature over supply signature, and we're going to have a lot of stepping stones on the way up. Okay, so let's look at the distribution, Bruce. In terms of the phases, we're still having the same intentions. Phase A is going to be the stop in action, and in this case, we're stopping the uptrend. Phase B is going to be about supply and demand, building the cause. The CO is going to be distributing a lot of shares of what they hold. Phase C is going to be this final test of the previous highs. And what are we testing there? We are testing the ability of demand to commit to the upside and sustain the trend. If that doesn't happen, we're going to fail and supply is going to increase, and we're going to see a change of character relative to the previous phases again. So from that perspective, Bruce, I would say that maybe the intentions behind the phases are going to be the same, but just going to be reversed, right? But what are the differences between, let's say, accumulation and distribution? Is it a function of supply? Is it a function of what big institutions are actually doing in this moment?
Distribution is like a race, because these large interests that have large numbers of shares of stock that are selling using. The reason that you have a ceiling on the stock price where you have resistance, which is a term that was coined by Mr. Wyckoff, is resistance and support. You have a resistance area. That resistance area is being defined by large sellers that are holding, checking the price and keeping it from rising further. And so that's what sets up distribution. Now, they're in a race. They're in a race to be able to sell at the best price possible to get out of their shares. Then when they are sponsorship, they are strong hands. When they no longer own those shares are now in weaker hands. And being in weaker hands, there's no organized support to hold the stock up. And when you get into the C phase and the D phase, you can see this inherent volatility that is in place because the stock is no longer being campaigned and supported by large interests, large informed interests. So volatility increases, and this is the reason why when a stock goes into a markdown phase, or the market itself goes into a markdown phase, the volatility of the declines are so dramatically large and the volume is high, is because of the quality or the lack of the quality of the ownership of the shares. And this is why distribution is distinctly different from accumulation. They look similar, they look like they're mirror images of each other, but in the actual volume price characteristics, they're distinctly different.
Mm-hmm. Okay, well, let's look at the example. Today we wanted to give you kind of like a quick case study. Bruce and I have done this so many times, and we always enjoy this process. This is probably kind of like where we want to stay for the whole session. So it's going to be a simplistic overview, but at the same time, we're going to stop and and talk about specific principles. Why they're important. What can you do there in terms of your analysis, and what can you do there in terms of your trading. So we're going to look at Biogen, and we're going to look at this huge trading range that we've had since 2000. With the change of character happening in this area right here. And this trading range has lasted for almost 10 years. And if we would be identifying a Wyckoff buy zone, so that is where we would be initiating or considering to initiate our position, long-term position, this is the trade that we wanted to show the composite operator is going to be involved in. So the composite operator, those big institutions, and by the way, when we talk about big institutions, we're not necessarily, I don't mean, hedge funds or mutual funds. I mean huge pension funds, insurance companies, the ones that are going to have billions and billions of dollars behind them, to commit to a specific industry group. And the way how they trade it, they're not going to specifically trade just one stock. They're going to find the leadership in the industry group in different stocks. So the way how they're campaigning is somewhat different than the individual trader, even an investor who could participate in this trade. So our goal and intention here is just find the conditions through the selection process that would lead us to this potential leadership, find the points of entry at the specific places, and then stay with the trend as long as possible and until the trend is showing a change of character. And this is where we want to exit. So let's look at how we would label this trading range, and let's just go through this, Bruce. Bruce, where would you start your analysis? So let's say that we don't see, let's say, phase C here, and we see maybe phase B and phase A. How would you look at those phases, and how would you start your analysis?
Well, I like to go over to the left and start with how the prior trend ended. In this case, it ended, there was a large markup, and you can see towards the end of the large markup that there's what we call preliminary supply, which all of a sudden, in a short period of time, you have this large decline that is a different decline than anything that preceded it in the uptrend. That is what we call a change of character. And that isn't the end of the uptrend, but it's a warning to us, because the characters that the interests that can cause a stock like this to decline that quickly is the composite operator. And so they started to actively sell shares late in the uptrend, and then checked their selling activities, and then they took it up into another continuation of the uptrend, which went to what we call the buying climax. Now, the buying climax and the automatic reaction, which is another big dramatic decline, sets the outer edges of the trading range. So this is very important. One thing you learned today, it's to draw the support and the resistance off of the peak of the buying climax and the automatic reaction. And from that point on, most of the trading in the trading range should oscillate between the bounds of those two extremes. And that's exactly what we have here. So that's the first thing I would do, is to define the trading range with those 2 points, those two simple points, and look at how long they bounded the trading range for Biogen. And so from that point on, then we start to look at, well, when do we go from phase A, which is a stopping action, it's stopping an uptrend in this case, to phase B, which is to build a cause where you have stock that's changing hands or being, in this case, reaccumulated for another move up, and taking many years to do it. And then phase C, which is your final testing area, and phase D, which is the markup out of the trading range and into a new uptrend.
Okay, let's talk about trading a little bit here. So let's say if I had a position open, in this uptrend, where exactly would be my exit? I mean, what are the points of exit that I could consider here?
Well, anytime you see a dramatic buying climax, which would be, you could say that that preliminary supply has all the attributes of a buying climax.
Mm-hmm.
It would be a place where some stock should be sold, and then a push above that, the peak of that preliminary supply into a second buying climax is also a place where stock can be sold. But then also the testing areas. So the secondary test, that failed upthrust, those are places that also stock can be sold.
Mm-hmm. Okay. In my classes with students, when we're talking about the trading tactics, and this is, a slightly not different technique, but maybe a little bit more detailed view of this area right here. Bruce has mentioned that change of character is an extremely important concept, and I actually love it so much. I spend a lot of time going through a lot of charts and working with students just on this concept. So one of the things that a long-term investor or a swing trader would consider here is that after we see a change of character, you not necessarily want to get out on the way down. Wyckoff would always say that we want to buy after the reaction, on the reversal of the reaction, and there are only several places where we could buy or sell on the breakout. So in this case, we don't want to necessarily sell into the reaction. What we want to do is understanding the contextual structure that the price is going to go up and retest at least this level. We just want to get out on the way up, and we can do this with the trailing stop loss, so our exit could be at this point somewhere. So please note what happens here. If we are still holding the stock here and then we are observing a change of character, again, we don't have to go away from this position right away. Our exit could be at the better price on the way up, and then we can go into our stop in action and the building of the cores. Okay, great. Bruce, so where exactly would we be looking to open a position to the upside, and how would we find that place in such a long trading range? What would we be looking for?
Well, most people would not have the patience, I guess, to observe a trading range that goes this long. But if once you have this in your radar, the next question is, as it's going through this reaccumulation phase, is you're asking, is this reaccumulation or is this distribution? And so that's a very important analysis that needs to be done.
And how can we define that?
Well, keep in mind that, and if you look at my blog, we'll show you how to get to the blog, the July 31st, 2015 blog. There's a discussion of this. But what happens in reaccumulation is it's just like accumulation in that the volatility is very high early in the distribution area, and you can see the volatility coming out of Biogen as you go from the phase B tends to be very volatile. Phase C will tend to be much less volatile. Phase D will have volatility to the upside. And so what you'll notice here is that the volatility is coming out of Biogen, which is a classic sign of accumulation. It's a sign of absorption, because once the stock is in strong hands, it becomes difficult to buy in large quantities. And so you can see here that it becomes less and less volatile, and it actually, the lowest low in this reaccumulation actually occurs in 2002. And each subsequent low that occurs through this entire area is higher. And that is a sign of absorption. And so here we can see that in point C that we have a pullback that takes it down, not all the way to the lows of the support area. And after that decline, there's a series of tests where there's the low is tested repeatedly throughout that whole area, never being able to get below that low. And so that is a classic sign of accumulation. Those areas can be bought. Also, the breakouts can be bought. And so, Ramon, you're really good with entries. Why don't you pick that up?
Well, one of the things here, as we're looking into this reaction, and we are at this point, we might be thinking, is this a potential phase C for us? And why phase C is so important? Well, because this is where the trend starts. This is from the lowest point in phase C is going to be the lowest point of the trend. So we want to catch that as it shows the final absorption of the supply. So therefore, our analysis would look into this area right here and how it is being compared to, let's say, previous points of supply that we've seen in the trading range. And we want to see that contraction of the supply after the expansion of the supply. And one of the characteristics for phase C that I personally would like to see is I want to see a long-term contraction of the supply. So in this case, the highest supply came in phase B, and then we have a very substantial decrease in the supply. And then I want to see a local increase of the supply going from phase B to phase C. Why is that important? Because as we go down, and as composite operator might be even pushing the prices down to check whether supply is available, this is the second point of fear in the whole trading range, where weak hands are going to distribute the stock and where the strong hands are going to pick that supply. The first point of fear was all about the stopping action. In reaccumulation, we might not see that more distinctively, but on the accumulation charts, you are going to have a climactic action that's going to have increase of the spread, increase of the velocity, increase of the volume, and that would show us that weak hands are fearful and they're selling their stock. So now that we are observing the contraction of the supply, we're still realizing that locally supply has increased. So therefore, we want to have some kind of testing action. And for the successful test, we want to have two simple rules. A structural rule would be to have a high-low for the test, and then the volatility rule or the volume rule, we want to see a supply signature to start contracting. So we want to see a higher lows on the contracting supply. And we can observe this from this action here, from these swings. So one of the things is when we see that contraction of the supply and we see a higher low, we just want to identify a reversal pattern, whatever technique you're using for the reversals, and just enter the position. And our stop losses would be behind a significant level of the supply. In this case, this is a significant supply locally. So for the long-term investor, this would be the most appropriate stop loss. If we are more aggressive swing traders and we're just waiting for this type of swing, then we definitely want to be more aggressive with the stop loss so that our average win to loss is going to improve. And Wyckoff discussed three major places of where we can open the position. One of them is going to be in phase C. And again, there are quite a few details here that we can go through as to how phase C could develop, where exactly in phase C we can open the position. The second place was on the way up before the price hits the resistance point. And on the sign of strength rally, and our preference would be to find a sign of strength bar. those bars are going to be long bars, elongated bars that are going to have preferably a high demand signature behind them, and that shows the commitment of strong professional hands to the upside. So on this type of bars, we can open at the close. If you're intraday trading, you can open the position based on your intraday techniques and then switch to the daily stop loss. There are quite a few opportunities there. So if this was the first point of entry for us, this was the second. The third one is going to happen after the commitment to the upside, after the change of character, and after a final test, a backing up action that will show us that supply is not capable to push the prices back into the trading range. And instead of going back into the trading range, the price tests the support, which was the previous resistance, and reverses and resumes the trend. So this would be the third place for us to open the position within the trading range. Later on, we're going to have a lot of opportunities to look into the stepping stones and to add to the position, on the way up. Bruce, what else? Here can we observe and note?
Just the idea that you can see here with the nature of the way that the advance is occurring, that you have these just persistency of prices moving up. And even if your executions on your purchases aren't perfect, that the reactions are shallow, the trends last a long time, and the trend is going to generally bail out a poor entry. So, I mean, we obviously want to work for really good entries, but notice how a dramatic uptrend, which is an indication that the stock is in strong hands. And the only thing that's going to get these large interests to sell stock is much higher prices. And so you can see here that there's just a very robust uptrend. And there's many places in the uptrend to make purchases.
Mm-hmm. I like this comment by you, Bruce, that the major supply of this stock is in the hands of the composite operator. And we could see this from the volume signature. And look at this volume, how it starts to contract. And on the way up, we actually see the volume decrease. And this is a very interesting phenomenon here. And I have a lot of questions about this, and a lot of traders since 2009 had a lot of problems identifying a lack of supply, and that with that lack of supply, the price can move to the upside. So a lot of the hedge fund managers or money managers have not participated in the rallies since the lows of 2000, 2010, because the whole volume signature is contracting. And in the conventional technical analysis, we're talking about volume confirmation, as volume should confirm the price movement in the direction, of that volume signature. Here it's an opposite thing. So why is this happening here? The reason why is all in the function of the supply. As supply is contracting and contracting significantly, and big interests are holding that supply of stocks in their hands, they are not allowing supply to come, to the market, and therefore, even with decreasing demand signature, we still can see the prices going up. So you have to think about contraction of the supply as an opportunity for low quality demand to push the prices up. There is no way that the price can go lower. If it's going to go lower, what big institutions are going to do? They're going to buy more. They're going to support the stock more. And once there is enough supply in their hands, even a small demand can push the price up. Another concept here which is extremely important, and Bruce talked about this a little bit, it's this rally right here with this reaction. this looks so much different than anything before that we've seen in the trading range. And we again refer this as a change of character. This first change of character was on the way into the trading range. It showed to us that there is something different is happening relative to the uptrend that we've had, and therefore we can expect a different trending environment. So from a trend, we're going into consolidation. In this change of character, on the way out of the trading range, we are changing the environment again. So from non-trending environment, we are showing not only that we are changing into the trending environment, but also a change of a character, in this case, is showing us a directional bias as well. So what is this change of character? What's so important about this? Well, if we're going to look at the rally that we have had here, this is the largest rally in the trading range. If we're going to look at the reaction rate here, this is the smallest reaction that we have encountered in this trading range. So therefore, something completely different is happening for the first time. There is also other characteristics that we can talk about, for the change of character concept. Commitment to the upside, increasing the spread, increasing the velocity. Sometimes we would like to see an urgency of demand to identify a potential leadership in the future, because if there is an urgency by big institutions to provide a lot of demand here on the way up, what does it mean for them? That means that they are willing to show their footsteps at this point, and they urgently want to accumulate as many shares as possible. So therefore, they're going to be holding on to those shares for quite some time. They're going to be seeking other opportunities to push the price up by buying more, and therefore, that's going to create that future leadership. That future leadership we can observe in the relative strength and comparative strength analysis, which Bruce and I are going to talk about in our next session, and I believe that session is going to be in April 4th, and then in May we're probably going to touch upon how can we actually calculate the potential of the cause that was created in this trading range to project what kind of effect we're going to have. And we'll talk about the point and figure counts and how Wyckoff did the horizontal counts and how they're different from a more conventional technical analysis counts. How are we on time, Dan?
47. We have 15 minutes left. It's fine.
Okay. Should we start with the questions, and we can finish the presentation by probably talking about additional resources right here, and then we can take some questions.
Just
that be okay?
Yeah, let's take some questions. The thing I'd like to point out about that very large-scale chart that we were just studying is that these principles work in all time frames. So here we are looking at a very large time frame, but if you were to look at a weekly time frame, which the next chart is actually a close-up of that area there on a weekly basis, and then daily, intraday, these principles are at work over and over and over. And so this whatever time frame you prefer to work in, these principles can work for you. And so here, maybe we can leave that chart up while we take some questions. But here is a blow-up of the area that we were just looking at in the larger context. This also makes the point is you always want to look at the larger context from the area that you're working in. So if you're working in weekly charts, you want to look at the history of the monthly data to see whether or not there's a story to be told, principles at work there that might either support you or work against you. And so in this case, we've come down to the weekly, and you can see that the principles at work here: selling climax, automatic rally, secondary tests, a big B phase, and then a C phase final test, which is a last point of support, which we just looked at on the monthly chart, same areas, but you can see here these areas, and then you could take a point and figure count of that base to gain some objectives, and then you have the jumping out, the backing up. And so everything there is at work, and you can see just the ease with which once the accumulation is complete, the ease with which prices just move up and out of this accumulation area and start their markup.
Mm-hmm.
And this is really what all we care about. We just are looking to identify the preconditions that set up large markup phases so that we can campaign and participate in these large markups and participate in the very best ideas which the composite operator is operating in. Go ahead. I didn't mean.
I was actually trading this stock right here. And the reason why, so what was the logic there? So I was looking at the larger scale time frame on the monthly, identifying this whole area as a potential reaccumulation, especially in this action right here, and especially after the sign of strength, major sign of strength, major change of character, and the backing up action. So I was looking at this place to initiate the position. Now, there is a lot of leadership on the way up that Biogen started to show on the sign of strength. So, and here is the same sign of strength on the weekly chart, so on the smaller time scale. So looking at this area right here, and it was 2011 October, we had a shakeout in the market, and the market did something like this. It was consolidating, then we had a shakeout, consolidation, and then we started a move to the upside. So during this area when the market was weaker relative to the stock, which was making a higher low instead of a lower low in the market, this stock has shown both prior leadership and local leadership in a smaller trading range. So when you go to the daily, and if you'd like to practice this, principle, a principle within the principle, a time frame, a trading range within the trading range. We have a trading range within the trading range in phase C here. We have a smaller range here on the backing up action. You could see that by looking at the highs and the lows, or if you're looking at the relative strength ratio as your indication of the strength or the weakness, you're going to see that the stock has exhibited a lot of signs of strength in this trading range, and the reversal out of the potential phase C here was the way to into that position. And right away you would be rewarded with this big move to the upside. And the reason why is because a lot of institutions are recognizing that the prior leadership has attracted a lot of institutional following, and the inability of the price to go lower and to create something that what the market has done shows unwillingness of big institutions to sell this stock. Therefore, they're going to be holding the stock further down the uptrend, and you want to be in this position. You want to be like this smaller fish that is going to follow a much larger big fish. And this is basically what we do. We want to see what the big fish is going to do, and we want to follow in the same direction. How's that for that analogy?
We just don't want to get eaten by the big fish.
Exactly. We just want to follow. We want to be friends.
Yeah. So do we have any questions?
Yeah, there are some quick ones.
Well, people, hold on a second, Dan.
Yeah.
While people are still writing the questions, I just want to mention a couple of resources, few resources that you can rely on from our side. And we've developed quite a lot of products, quite a lot of lectures, webinars. So one of the main things, and this is where it all started, and Bruce and Hank Pruden has started this program at Golden Gate University. There are two main Wyckoff classes that we teach, a 5354, a 5355. We teach those classes on campus, and if you're close to the Bay Area and you have this opportunity to take Wyckoff classes from Hank Pruden, and Bruce sometimes joins those sessions as well, I would highly, highly recommend to go and be taught by Hank. We also have those classes online, and I teach those classes online. We just started the new semester, and I'll be teaching Wyckoff 1, Wyckoff 2 this semester. Bruce has an incredible blog that has been going on right now for more than 6 months, and he has so many entries in his blog about Wyckoff method. And what Bruce is doing there is he is describing the methodology. So you can literally sequentially start reading on how to approach this method, how to start applying it in your analysis and in your trading. Another source is wyckoffanalytics.com, and this is my private source. This is where I privately teach the method. We do have different classes. I teach a Wyckoff trading course, advanced Wyckoff trading course that lasts for 4 months, and then we go into the Wyckoff practicum course that lasts also 4 months. This is where we practice the concepts that we have learned in the Wyckoff advanced course. So check out all of these sources. All of them are great, and we can go to questions then.
Good. Akram, would you please read the questions?
Yes, thank you, Dan. We have the first question from Brian, and he said, you show a 10-year example. Does this method work in shorter-term environments? Like, is it fractal, in nature?
And we touched on that, but it is fractal in nature. You'll see these conditions set up in all time frames. You can see it on daily charts, weekly charts. You can see it in the intraday, and so it's whatever time frame your preference is, you'll be able to use these principles and be able to employ them for your trading.
Yeah, and there are quite a few questions from students about the intraday. Like they would ask, well, what would be the difference? The principles are still going to be the same. Yes, there are some minor adjustments and differences that you have to consider during your intraday trading. For instance, just sudden volatility, where some institution can come and just create a counter trend move with a lot of supply, let's say, or with a lot of demand, and whatever reasons they're using there, it could be their reasons. We don't know them, and we don't really care. All we want to do is to observe how that's going to be put into the context of the bigger structure and into the context of the trend that we're having right now. So we go through quite a few intraday examples as well, showing the principles there.
Okay, good. And we have a second question from another Brian, and he said, the latter half of phase B looks to me a lot like phase C. How did you know it wasn't? Until you see it breaks through the top of the trading range, and how can you tell?
Okay, Bruce, I think that Brian is referring to this area right here, and Brian, please tell us if this is not the case, and then, this and this two areas here in B and C. What's the difference? Is that how? Mm-hmm. Go ahead, Bruce.
Yeah. Okay.
So there's it's always possible to see something, identify it as being the conclusion of the testing area, and then have it continue on, especially in a large chart like this. The one thing that you'll notice is in that last run-up to the high, where the buying climax is being tested with the sign of strength, is that there's a huge amount of volume as it's pushing up there and pushing up and out, and that high volume coming towards the end of that, we would interpret that as being a sign of selling, not of accumulation, because accumulation tends to happen in the bottom half of the range. So that would make us a little cautious up there. That doesn't mean we didn't attempt to trade that at the secondary test and trade it to the top of the trading range, but that very large volume would be a flag. And then also the failed tests that occur after that upthrust action would lead us to believe that it may have to attempt to go back down towards the bottom of the trading range. The thing that we're prepared for in accumulation is that once you get to the top of the trading range, get up into resistance, that we expect that the market is going to attempt to go back down to the bottom. And how it goes back to the bottom is going to be really important to us, because if it can get all the way back down, or if it can only get part of the way, the volume signatures on the way down and so on are going to lead us to draw conclusions about how close we are to completing the accumulation.
Another point here, which is, I think, extremely important, because some of the students are going to be thinking, okay, if we're in phase A here, we should have a test in action in phase B as well, and then it seems like this could be a potential phase C. So the key here to think is the supply signature. What is happening with the supply? Supply is definitely increases, and in some accumulation instances, we might have that signature, but those are going to be very rare. Increase of supply of such magnitude would dictate that we would have some kind of retest of the same area later on. And because this trading range is so huge, and by the time this action happens, you've actually been in the trading range for 1, 2, 3, 4, almost 5 years. So you might be thinking that your retest might happen, far away from where we are testing this support right now. Plus, looking at the market conditions at the time, we still were in the uptrend, so that would dictate a rally. And Bruce's observation about this increase of effort versus the decrease of the result, where we can't commit to the upside. It's a better result than we've had here. It shows us that there is some interest from big institutions, to mark up the price. But this inability to commit above the resistance and a lot of effort with smaller result actually produces a short-term bearish picture for us, and we can expect some kind of retest back into the trading range, and retest of what? Retest of this low right here. So as the price goes down, as Bruce was saying, we would be observing what kind of supply we have here. And right away, we see the local increase of the supply that suggests that after this bar that we're probably going to retest the support. Stop in action right here, and then this further absorption is going to tell us that this retest that we waited after this point of the supply has happened, and it's successful.
And just as a footnote, if you look all the way over on the right side of the chart, which is up to date, you can see that there's a change of character in the way that the stock is acting, and the volume is coming in, expanding on the decline off the peak. And so there's a change of character that's occurred in this stock, at least for the time being.
And by the way, this change of character, Bruce, what would it mean? That would mean a change of character from a trending environment to either non-trending environment, or we might have some kind of potential test and just a continuation of the downtrend. So change of character is an extremely important concept. I think it's very underlooked. I think it's not being explained in the conventional technical analysis as much as I would probably personally would prefer. And Wyckoff has this layer of knowledge, and even though it's a simple tool, but it's extremely useful.
So how are we doing for time? Do we
have more time for more questions?
Yes, we have 7 minutes left. And we have one more question from Ricardo. Are gaps considered as signals of change of character?
Sure. One of the exercises that I do with students is, and here we cannot see a lot of gaps. If we would go to the daily chart, that would be more obvious. But maybe on the weekly here, you would kind of could start seeing, some of this changes of character and how gaps are helping us to define that we are changing the character from in areas where supply is more dominant to the areas where demand is more dominant. So if we would look at this whole chart, and here on the daily, these two bars that are acting out, as big weekly bars, probably have daily gaps, and those gaps are probably going to be quite significant. So we could see gaps here, here, and then after that, as we go down and as we start consolidating, we can start seeing some gaps that happen to the upside, which has not happened before. So what is happening then, in this area? If we are having those gaps, that shows an urgency of the demand, a presence of the demand right there from big institutions, and therefore we are changing the environment from, let's say, environment of the supply, environment of the downtrend, to the environment where supply is being observed on the way up and where demand might be pushing the price to the upside. And then again, going through the consolidation here, we might observe, some gaps to the downside. That just tells us that supply is still present and there is some testing action that needs to happen. But then when the price is starting to go up, is starting to register higher lows, higher highs, and supply has gradually been observed, we are starting to have the gaps to the upside that are showing us a different type of story. And again, on the daily chart, that's going to be more evident because you're going to have more gaps. But you can definitely do that type of study, and, kind of like go to the change of character idea, or, just look at the gaps, how they show a change of character as well.
Okay, good. And we have one more question from Manish. Is there an AFL code whereby I can plot them on my graph?
I'm sorry, what to plot on the graph?
An AFL code. You mean he means for the Wyckoff method?
You mean like the phases, labeling?
Yes, I think he means like a trading to make a trading system or an expert.
Mm-hmm. Well, I mean, I've seen quite a few. I wouldn't say that there is a lot on the market, but the ones that I've seen, I tend to go away from them because the beauty of the Wyckoff method, all in the context, and Bruce, I want you to elaborate a little bit on this as well, from your experience, but every time I looked at the software that claims to label automatically, the phases and Wyckoff events in the trading range, I usually don't find it very useful. I find it, a little bit misleading because there are a lot of mistakes there, and it's just because there are so many variations of the trading ranges that we could observe. If there would be only one accumulation or one distribution pattern, we can definitely program that, but there are so many. So one of the things that I always advise to people who try to encode the principles, and principles of change, principles of, going through supply absorption, principles of price behavior. Those are much easier to encode, and those are still Wyckoff principles, and you can build the whole system based on that. Bruce?
Good answer. The only thing I would add is that I've seen attempts at trying to capture volume signature, volume and price together in some kind of a code. And
like a VPA volume price analysis.
Yeah, and so the thing that is always missing from that is the context. And so, and I write about context in the blog. Phases are context. So when something happens in phase A or phase B or phase D or phase E, it has a different result. And so unless you understand where you are in accumulation or distribution, or where you are in the uptrend, it's very difficult to be able to create a consistency in some kind of a signaling system that would give you consistent results. And so this is a judgmental system. And so you can create a method out of it, and you can follow rules. It has excellent rules, but in the end, the judgment of the operator, your judgment, is going to be the key to the success here.
Here's an example of this idea that even with the VPA analysis, and this is something that I was talking, HDSI software has this new VPA feature. So one of the things there, and we know TradeGuider I think has this VPA feature as well, and some other softwares. And again, where is the context here, right? So if you're looking at the same type of bar, this bar looks the same as this one. Look at the type of the spread. Look at the close, where the close is relative to 1/2 of the point. Look at the volume spike here. The demand is present there. But is it truly just demand? In this case, contextually, where we are with this bar, we are close to the resistance. This is an attempt to commit to the upside. And after that, the price goes down. So this bar is not going to have just demand signature. It's going to have a demand signature that is increasing plus supply signature that is increasing as well. At this point of time, demand is going to be still prevailing over supply, but then on the next bar, supply is going to take the price down, and this signature is going to change. In this case, this is a different signature. We are seeing demand is increasing with supply contracting, and demand is heavily outpacing supply. So same type of bar with the same volume signature in contextually different places could mean different things. And therefore, if those softwares cannot define the context, and they can't, I still have not seen a software that could define the context in the way that, let's say, we Wyckoffans would like to do, then you're probably going to make mistakes just relying on those signals.
Okay, good. So I think we ran out of time. So I thank you very, very much, Bruce and Roman, and it has been very interesting presentation. And I hope everybody